This week, we'll start things off by looking at the broad equity market via the S&P 500 index. It is, of course, the benchmark for U.S. equities, more so than the NASDAQ, the Dow Industrials, or the Russell 2000. And despite the fact that you still hear people on TV commenting and talking about the Dow as how the market did that day, it's really much more a publicly watched figure. The institutional community really pays attention to the S&P, and very few portfolio managers are benchmarked versus the Dow as compared to the bulk of portfolio managers, certainly on the long-only side of the business, who are benchmarked against the S&P. So that's what we always concentrate on and talk about with you. Then I also want to spend the rest of today's show, after we take a look at what the broad market is saying, at looking across the metals complex. And we'll actually look at charts of gold, silver, platinum, palladium, and copper. And even though copper is the only base metal there, the rest are precious metals. It certainly is an indication of how people feel about the economy, what's going on in China, etc. So we will cross from precious metals into the base side to at least take a look at copper. And then if we have time at the end, which we never quite know, just depending upon how in-depth we get into things, if we have time, we'll take a look at some of the more commonly held specific metals equities. As always, I am here to educate you in the ways that institutional portfolio managers and institutional traders look to play the markets, which is often from a very different perspective than does how an individual investor look to do things. So, of course, one of the more important things right off the bat is each week I show you technical indicators and timing models that most of you are unfamiliar with, and many don't even know exist in the marketplace, and that's, of course, why I like to expose you to them. I often describe their usage so that you can get a better understanding of the professional investing and trading process. I do this to allow you to see how different approaches exist well beyond the tools you're accustomed to using. And I do the same type of analysis, whether it's for my institutional clientele through Bensignor investment strategies, or for my individual investor clients through my weekly tactical trader report from In the Know Trader. So if after listening to this cast you want more information about our tactical trader weekly newsletter, please, and of course how to subscribe to it, please visit www.inthenowtrader.com. So now that we've gotten kind of the intros out of the way, let's start off by looking at some charts. So we're going to flip and take a look first off at the S&P on a weekly basis, and then we'll cut it down to a daily basis. On a weekly basis, the key things for me include, and again, we'll use kind of an ellipse to help identify levels I'm talking about. So this level in here, which is kind of teal-colored triangles, that is called, that was the upside DeMark propulsion exhaustion target of a move that started down here with these kind of darker green arrows. So getting through that 26.25 or so level, projected that we would get as high as about 29. I think the actual number came in at 29.12, and we have pushed through that. So even though we've stalled against pretty much the 29.40, 29.50 level, which were all-time highs back from last fall, I do believe that this move will still target 29.99 as a first level, and then 30.67, or actually 30.68, and then we'll add in there 31.29. So those are the three bigger upside targets. Again, 29.99, 30.68, and 31.29. So in the bigger picture, I do think we go there. But of course, there's some short-term concerns in the market because of really starting with President Trump's tweet Sunday night that threw markets in disarray and had to see, an unexpected pullback. And look, I like to think of, when I analyze markets, I like to keep politics out of the equation. But I can tell you, even as a strategist and someone, many institutional traders and portfolio managers rely on to figure out what's going on in the game at any given time. When you have someone who randomly tweets and uses Twitter as their source of communication anytime, any place, without going through typical channels that someone holding that office would go through, which is their press secretary, and things get approved beforehand, you get these times where the president can just say something and throw markets a little bit into disarray, as what has happened over the last couple of days, especially because just last week he had said that by Friday of this week there was a good chance of having this China trade done, only to Sunday night saying that he's increasing tariffs up to 25% from 10% on $200 billion worth of Chinese goods. And that has obviously concerned the market. So we've seen the pullback this week. The levels that I think are important levels to look at, I'm actually going to take, I care less here about, let's say this purple line here is a 50-day moving average, and down here is the 200-day. Those are less meaningful to me. What's more important right now, I'm going to highlight these levels here. This level, this level, and let's say in here are kind of the important levels. So right now that shows up to 28.39 down to 27.99 will be the key support for the market on any further decline. Again, I think less about the those 50 and 200-day moving averages, and look more towards what some institutions are going to look at and play off of should those numbers come into play. You can see also that over the last few days, you've had predominantly closed candles. You had one up day on, let's see if today is Tuesday, so that was Friday. We had the strong up day, but yesterday, big down day. Today, we've opened on the highs, and we've continued to sell off. Last time we saw something like that was the period in early March and mid-March where we had a bunch of black candles. Otherwise, if we go all the way back to the beginning of the year, you can see we have mostly open candles as the market has ripped higher. And as you would expect over time, that when a market moves up as sharply as the U.S. market did, most days are going to have closes that are above the open. And therefore, the open candles, or what at least on my chart appear to be hollow as compared to the ones that are filled in black, which represent days that the close is less than the open. So again, these are the downside targets as far as S&P. I've given you upside targets in the bigger picture. So to me, these basically 28.37 and 27.99 are the key shorter term levels that bulls would want to see hold up on a decline. Next, so that's the S&P picture. But again, I said that I want to take a look at the metal section of the market. So we're going to look at bullion, and let's start off with gold. And we'll look at gold on a weekly basis, and then we'll cut it down to a daily basis. So here's kind of the bigger picture in gold. We know that, and these are gold futures traded on the COMEX in New York. So these horizontal lines represent major highs from the past. If you know anything about DeMark models and exhaustion of trend, when you get a 13 count coming on top of price bars, they all represent potential exhaustion of trend. In this case, it's exhaustion of uptrend. And so those very aptly call the highs. In fact, even back here, we go to 2014, that one did too. So we're working off of this down here is the secular bottom for gold. So this is as low as gold got from the all-time highs back in 2011, and you can see, this is the current kind of uptrend we're working with. What's important now is, here, let me add, the two levels I'm looking at of significance, or in fact down here now, is 1242, this level right in here, as potential support. And I've indicated to clients that I think that's an area that if we got down to, they'd want to do some buying for investment purposes, not necessarily trading, but for investment purposes. And if we flip this to a daily chart, you can see it's a little tucked away here. Let me spread things out. First of all, by the way, notice all the 13s that showed up on the bottom last summer on the daily chart, multiple 13s indicating downside exhaustion of trend. We've got an upside exhaustion here that played with its stop out level but did not get stopped. And then recently we got a 13 towards the downside. So most people look at the gold chart and kind of see a basic head and shoulders pattern here. We had two shoulders on the right-hand side that broke. And, if you do a typical measure, this looks like about 1290 up to 1350 in round numbers. That's a $60 move. So that would get you down to 1230 or so as a projected target on the downside. But you can see we had the big day down that broke the head and shoulders, and we have not gone down since. And that, to me, is because, and we notified clients of this, don't necessarily get suckered into playing the head and shoulders breakdown, because there is actually a sign here for downside exhaustion. And it doesn't have to mean that it stops there, but it certainly made us a heck of a lot more cautious about jumping on the short bandwagon to play for a further decline. So we're kind of neutral in here now. Obviously, there's going to be overhead resistance. Gold really needs to get properly above this 1309 level in order to really kind of get legs on the upside. And using the models I do, there are rules. So just breaking through this line is not enough to get you long. It's how you break through it that matters. And so that's what we're looking at now. But should gold decline any further, then I'm gonna look to be a buyer down probably near anywhere from, I'd say, 1245 to 1230 or so. So that's gold. Let's move to silver. I know you're here somewhere. That's interesting. Hold on one sec. Let me make sure. Yep. It's funny, I put these up last night, but I don't see them, so I'm just going to switch this chart to a silver chart. Here we go. So here's silver. And silver broke also. Yeah, well, actually, let's even take that line away. So silver's been responding fairly well to what we call setup 9 counts. It's a pattern, again, one of the Tom DeMark models, that starts off by saying if you decline 9 price bars in a row, that the close of each price bar is less than the close from 4 bars back, you potentially have a temporary stopping ground for whatever that trend was. And in this case, you see we did 9 down, and then silver made a major recovery. Ultimately, that 9 down led to a further, within that same model, it identified this level right here as being downside exhaustion, which it nicely caught. We've done a 9 down here into a 9 up, and this is a weekly chart. So these are 9 consecutive Fridays that the close is less than the close from 4 Fridays prior. And again, it's often a time that you get a counter trend move. We've done it to the upside, and we've just done it to the downside again, holding. So let's look at this green line. That goes back to also to the same important low. Same time gold bottomed in 2015, silver did also. So if we blow this up a bit, well, actually this line I think is transposing itself from the gold chart. So I want to remove that one. And let's just quickly put up a trend line and see. If we go to the lowest low, all right, this is much more of kind of a horizontal line. There's just a little bit of slope. The most important thing to me here is that we've done the 9 count down. We're still above this 1439 level, which is the propulsion down level. So as long as we hold above there, then I think you can kind of do a little bottom fishing in the silver market. And on the daily chart, a couple days ago, you get a 13 exhaustion signal here. And of course, silver bounced very sharply late last week, that huge up day that recovered the 2 days before it, and it's kind of hanging in there. So I'm more inclined to be on the long side of silver, probably even more so than gold. Let's take a look at, boy, it looks like everything I put in here last night disappeared. So I'm just going to go to the chart. Let's look at platinum. And again, you can see one of the nice things is these, often the accuracy of the exhaustion. 13 down into 9 up, 13 down here, bounce, 9 into a 13 bottom, into a 9 up. And now platinum actually had a weekly 13 sale a few weeks ago. And that's where we had been long this. That's where we actually exited, average price about 900 or so was the average exit. So we're right now on flat platinum. I am looking to get long on pullbacks. We have seen actually a pullback as low as about, I don't know, I think it was just, we talked right under 850 last week. 847 is the low. But, having seen this exhaustion signal to the upside, and then, of course, what's going on with China, this is an economically sensitive type of metal more so than, let's say, gold is. And therefore, that's why we're seeing some pressure. Get me down back here towards 800, and I'd probably be a willing buyer again on the assumption that last summer's lows end up holding as lows. So that's my thoughts on platinum. Let's take a look at kind of a very funky market that not a heck of a lot of people trade because it's awfully thin, and that's palladium. And palladium's had a heck of a run. I want to take all these other, there we go, just kind of clean up the chart. And palladium is something, by the way, besides my doing these shows, which you find on stockcharts.com as well as YouTube, I also get interviewed with some regularity from a place called realvision.com. And I was on Real Vision a couple months ago, actually shorting palladium at 1521. So let me switch this to a daily chart. So I got short somewhere. I think I was playing in here. So this worked for a while. It kind of traded in and out, made some money. I held it against me, and then it collapsed over $200. It was actually a spectacular trade. And as of right now, this you can see that basically this level is holding, which is just in and around the 1300 level. So you've got the big down move after, and by the way, these are all-time highs. So unlike other precious metals, palladium skyrocketed on a shortage of the metal and became the most precious of precious metals. So now we can almost look at, let's say, this zone here as a consolidation. Now, it could be a consolidation that ends up moving higher in what was a bull market, or it could just be kind of a sideways pattern that ends up dropping one more time. And right now, I'm not willing to make the guess which way that goes. I tend to be more favorable of metals than I am a bear in them. And given that, at least even on a short-term count, this is a daily chart. We're on a 7 count in a couple days here. We might easily, with some down move, get a -9 count and create a bottom. So the big thing is this metal got way ahead of itself. I actually, on the Real Vision interview, once I was short the palladium at 1521, actually went long platinum against it as a pair trade at 830, which again, I told you we just kicked out at 900. So we were very fortunate because both sides of the pair trade actually worked. Right? Palladium fell $200 and platinum rallied $70. So this was one of those few home run trades you hit a year where both sides of a pair trade paid off big. And right now I have a little bit of platinum left. I am flat palladium. And again, kind of watching what happens over the next few days to see where and when that 9 count might come in, how much it may break underneath here. I'll give it a little breathing room down to, let's say, 1289. Much beneath that, I'm not sure. Or I'll then reference 1289 as a level to lean against, whether it's beneath or above. Or if it breaks underneath and comes back above, then I'd probably look to get long palladium again. I have to. It's just right now, I can't tell you which way it's going to go, but I'm certainly got my eyes focused on it. And then what else? So we did the precious, have we done gold, silver, palladium, platinum. All right, so let's take a look at copper. And this one, I will tell you that most of the people on the street have got it wrong. I've watched so many interviews of people who are bullish copper, and they've been bullish from the mid-290s. So once we look at the, I mean, look, I can go multiple times here. 13 upside trend exhaustion, 13 upside trend exhaustion into a 9 down. The 9 down ultimately led to the 13, which is the lowest low here, and rallies back to a 9 up. You know, and here, go back to even these signals on the left side. Perfect kind of models. And why we incorporate some of the DeMark models into our analysis is it often gives us a very good time or ability to know when not to play the direction of the trend. Doesn't mean I necessarily fight it and turn a long into a short, but it at least gives me some sense of when not to be doing of what we're supposed to, when not to be playing the trend for the full basis of the trend. And so here now, this level here, let me blow it up so I get it kind of accurate here. I've got to uncover it. I can. There we go. So it is 2.801, basically 280 is the key level here. Getting Friday closes underneath it suggests move down to 260, the low 260s. This is kind of very important support right in here for copper. So most of the people I've seen and interviewed, several people on Real Vision, are all long from up here looking for what had been a breakout that hasn't come yet. If we hold in here and come back, that's a good thing. And ultimately, if we take out these highs near $3, you'd next target just about 314, 315 up to 325. But right in here, you could lean towards the long side and stop yourself out, you know, a few cents lower, just playing that this level is going to hold. But beyond that, I'm a little concerned of just how many people are stuck long from higher levels. And this is the daily chart, and same thing. Take a look at 13s. All these 13s are upside exhaustion signals. So now we've done a 9 down. We're holding some important short-term support at 278 and change. Again, so we've got some reason that if you're aggressive, you might want to nibble on copper, but also realize that there's going to be overhead resistance here. So I wouldn't really play for much more than 288. It's a quick trade of, I guess, about 3% or so, and that's it. So that's when when I look across the precious metal space and think about what we're seeing here, they're all kind of stuck in some type of trading range, and a lot of it has to do with, in fact, let's take a look at the dollar. So first we'll look at the dollar on a weekly basis because that's kind of the bigger picture, and then we can cut it down and look at the daily. 9 bottom back here in 2016. This is a weekly chart, led to 9 weeks close above the close. And realize if you look here from when this 9 count came, it came in May of 2016. The dollar moved up, pulled back, but notice you don't see a count there. The only time you see the count is because it's got to be consecutive weeks without a break, meaning 9 consecutive weekly closes that the close is above the close from 4 Fridays prior. So in here, we started the count, and in real time, this was moving up and counting, but then this bar here killed was no longer a close above the close from 4 Fridays back. Eventually, this peaks on a 9 count, sells all the way down, temporarily stops going down on a 9 count, gets a minor counter trend rally, but ultimately finishes out the 13 count here, and that's your bottom. On the upside, you've got a 13 and 9 count right here, and you've got a 13 count a week before. In fact, the week that made the high. So this is also why I think a lot of people are bullish copper, and the charts aren't necessarily supporting it. Now, again, the dollar. In this case, you've got signals that are potentially calling for the end of the dollar rally. If the dollar pulls back, it'll be obviously should be good for metals. If it keeps breaking out towards the upside and continues to go, then you have targets at just about 99, and depending upon where the next 13 comes in, it'll be somewhere likely before 100.45, but that would be another upside target. So a lot of markets are stalled right now because the dollar is stalled, and that ends up driving the metals market. So if you don't have the dollar really directionally moving, it's going to stop the metals from directionally moving. I think we are just about out of time. So what I want to tell you is, if you want to contact me, I'm available via email at rick@inthenotrader.com. If you want to check out our website, it's www.inthenotrader.com. And again, there's more information there about who I am, my background, the fact I spent years as Morgan Stanley's chief market strategist. I'm an ex-12-year pit trader, and have 37 years on the street, and bring all that knowledge along with institutional models to the marketplace. Thanks for listening. I'm Rick Bensignor.